Hi, John. Thank you very much for joining us today. How are things in Wyoming?
Hey, doing great. Thanks for having me on. It's good to catch up again.
John, UR Energy is unique for a couple of reasons. First, it's located in the state of Wyoming, and second, it uses the ISR production method to extract uranium. ISR is much different from traditional hard rock mining. And before we begin with an overview of your company, why don't we just start with a brief explanation of ISR mining and what are the benefits associated with it?
Yeah, you bet. In situ is such a unique process. It's been around since the early 1960s. In fact, it was kind of pioneered at our Shirley Basin project here in Wyoming. We believe that was the first in situ mine for uranium in the world. But it offers a number of advantages over conventional mining. First off, the capital expenditure for in situ is very low compared to conventional. When we build out our Shirley Basin facility, which will be ISR, the cost to build out the plant and the first mine unit, we're looking at about a $30 million expenditure. That's nothing compared to what you would have to pay for a conventional, where you would be looking in several $100 million to build that out. But also very importantly, you can address very low grades with in situ mining at a very low cost. So in Wyoming, not just our company, but other companies as well, when we apply that technology, we can recover grades down to 0.04% at a operating cost that is very similar to what you're going to see in the Athabasca, where they're recovering grades of 10 to 15%. That's amazing. Several orders of magnitude different in head grade, but yet we can still compete with that because of the technology. But also the environmental footprint with in situ is really small. We'd simply install water wells. We don't have open pits or underground workings or tailings. And when we get done mining, we clean up the groundwater, we take the wellheads out, and when we're gone, you can't even tell we were ever there. The ground can be returned back to its pre-use. So a lot of advantages to in situ. It can't be used for all host rock types. It's fairly well restricted to just sandstone, so it does have that limitation. But if you've got a good sandstone hosted ore body, it's a great technology.
That was a great overview. Let's move on now. The US is the largest nuclear energy producer in the world. 20% of its electricity comes from nuclear. However, the US imports most, if not all, of its uranium, approximately 50 million pounds a year. UR Energy will be one of the few producers in the US with its Lost Creek and Shirley Basin assets. And I want to get a better understanding of both assets and where they are just in terms of production and also the economics behind each asset. Lost Creek is the largest of the two and the most advanced. So why don't we just start there? Can you just provide us with a brief overview of this asset? How many pounds are there and what is the grade?
Yeah, so Lost Creek, we started production there in 2013. We've produced nearly 3 million pounds since then. The last few years, we've allowed production to decline because the market has been depressed. But we've been working to layer in contracts, and in December of last year, we announced the decision that we're going to ramp up production. So right now we are focused on drilling, constructing, and we're literally within a few weeks of having significant flow and production through the processing plant there. So it's an established mine, fully licensed, permitted, everything's constructed. We just need to simply advance it. The resource in the ground at Lost Creek, 11.9 million pounds of measured and indicated resources, another 6.6 million pounds of inferred. The grade is about 0.05%. As we talked about earlier, the grades can be low with in situ and still very profitable. So in the past at Lost Creek, our C1 cash cost, we've been down in the low $16 range. We believe we can get back close to that. Because of inflation, we're not going to get right down to that exactly going forward, but we believe we can get close to that. And the all-in cost for the mine site, historically, we've been right around $33. Again, we can't get right back to that, but we believe we can get very close to that going forward. So a very good low-cost producer, technically very strong. We've had great recoveries, about 90% on average over the life of the mine, which is pretty much setting the standard for the industry. So we're excited to get that property back up and running.
And what is the mine life?
We are looking at a 14-year mine life with the known resources. But we have a lot of opportunity at Lost Creek to explore. We have 35,000 acres of BLM and state land that we work on. And if you take a look at our technical report, you'll see that there are a lot of redox fronts that are mineralized, that we know they're there, but we've not chased them to their ends. So tremendous opportunity for growth in that resource. We've done a total of 6 exploration projects on that asset. Every time we've done exploration, we've been successful at finding more pounds, and our discovery cost on that particular property has been about 50 cents a pound. So we'll get back to exploration one of these days after we get ramped up, but for not right now, we're relying on that 14-year mine life to get things up and running.
And in terms of production, what are you currently producing? And maybe you can give us a little more detail associated with this ramp up. When you are fully up and running, how many pounds will you be producing annually?
Yeah, so right now our production is very, very low. It's negligible. We've never shut down. We've continued to flow and produce, but it's insignificant. This year, this calendar year, by the end of this year, we hope to have put between 200 and 300,000 pounds in the can. That'll be sufficient to satisfy our contract for this year. The contract book next year goes up to 600,000 pounds. So we'll produce between 600,000 and 800,000 pounds next year to fill those contracts. So that's what we're looking forward to as we ramp up and getting production going.
So the decision to ramp up is just based on contracting?
It is. You know, we're a pretty conservatively run company. We typically don't like to sell into the spot market because it's too ephemeral. It's high prices today, low prices tomorrow, depending on what Sprott and others are doing with that market. So really, we prefer to sign it up and layer in long-term contracts with stable utilities and use that as justification to put the capital in the ground to ramp up production. So yeah, our decisions on ramp up are really predicated on our ability to do contracting, and we are working now to layer in additional contracts for the years going forward.
But John, given the economics behind uranium and given this backdrop, it looks so positive, and I think we can safely assume the price is going to be significantly higher next year and in the ensuing years. Why not just produce and keep it in inventory until we get higher prices?
Yeah, so there's a real cost to producing, and capital is precious, especially we don't know where the broader market is going to go. Most people are calling for a recession. And so if we take our precious capital, we put it into the ground now and say we produce 500,000 pounds this year with the hopes of selling it next year, we don't know for sure where that market's going to go. And if we put all of our capital in the ground, we can go broke that way. And so it's just not a path we want to take. But by ramping up and selling into contracts, we still have a lot of capacity at Lost Creek. And once we have all the employees hired, we have all the rigs on site, the contractors on site, we've got significant flow, ramping it up above our contract level so that we can sell into spot, that becomes easy at that point. And so that's the position we're trying to put ourselves, is we have that good base revenue from contracts that justifies putting the capital in the ground. And if the conditions warrant, spot market goes higher, then we can ramp up very quickly to sell into the spot.
So you just touched on capacity. Why don't we discuss that? What licenses do you have? How much can you produce annually? And also tell us about the processing plant. How much can you process given the permits?
Yeah, we are fully permitted at Lost Creek. The plant is fully built out. The well field, or the mine portion of it, it's licensed at 1.2 million pounds per year. And the processing plant is licensed at 2.2 million pounds per year. The difference between the two, the delta, is intentional. And it's because we would like to be able to bring in material from our other facility, Shirley Basin, or others in the future, and process it at the Lost Creek processing plant. So that gives us some room to bring in and toll process for our other properties, but also for competitors that are working in the area. And so it takes us up to 2.2 million pounds per year.
And you brought up the fact that there are competitors in the area. Has anybody approached you about using your facilities?
We haven't had any serious conversations yet. We've had some conversations more in passing, but I think as competitors develop properties in the area, we're the logical place to take those pounds, both within the Great Divide Basin and also in Shirley Basin, which we'll talk about in a little bit. There are a number of small projects that are owned by competitors. They're small enough that they are worth chasing, but they're not big enough to justify a full processing plant. So since we're going to have the processing plant there, it would only make sense for them to put in a small in situ facility and either pipeline directly to us or put in a small satellite and bring the resin over to us. So we expect we'll have more conversations on toll processing going forward.
Okay, so that's a good segue into Shirley Basin. Why don't we just start off with a brief overview of this asset, how many pounds there are, and what is the grade at Shirley Basin?
So the grade at Shirley Basin is very good. We're looking at nearly 0.25%, which is a very good high grade for in situ mining. The resource there is 100% measured and indicated. So that has been completely drilled out, 8.8 million pounds total. Not a massive project, we recognize that, but the reason we acquired the project is simply because of the quality. It's very shallow, the grades are very good, it's completely drilled out and defined. We have all of the historic records. The roads are there, power lines are there, even some of the buildings are there. So we believe the cost of production at that particular plant is going to be actually lower than at Lost Creek. And so as far as licensing goes, we have all of the major licenses and permits in hand, and we're waiting to make a decision to build out that facility as we layer in additional contracts for sales. And again, much like Lost Creek, we're not going to put the capital in the ground until we have line of sight on revenue from that property. So we're working on contracting and layering that in. Once we have sufficient contracts in hand, we'd like to have at least 500,000 pounds under contract for Shirley. But once we have that, we'll make the go decision. And building out that facility, because it's a satellite, it's not a full plant, we can build it out very, very quickly. Probably on the order of 18 months to completely build it out and ramp it up. And the capital cost, we're looking at probably around $30 million. We've got some inflationary pressures on that number, so we'll probably go a little above 30 million. But again, the capital expenditure on that is pretty minimal.
And John, when both Lost Creek and Shirley Basin are up and running at full capacity, what will be the annual production?
So again, at the well field at Lost Creek, capacity there is 1.2 million. The capacity at Shirley is 1 million pounds from the well field or the mine. So total capacity of 2.2 million pounds a year. And we would like to push that. We're not going to just give up those pounds for free or break even. We want very good profit margins on an all-in basis. But we would love to get it up to the 2.2 million pound a year run rate. And also would like to start toll processing for competitors, and that would allow us to take our capacity up to 4.2 million pounds per year, which is a very meaningful number, and would start to put us in the mid-tier for production. And again, Lost Creek's built out. Shirley Basin is fully licensed and permitted. It can be built out very quickly. So it's very plausible that within 2 years, we could be at a 4 million pound rate coming from the plant side of things.
I want to move on now and discuss your contracting book. You mentioned earlier that you have 600,000 pounds under contract. Maybe you can give us a little bit of color on that. What are the terms associated with that? And is it all with U.S. utilities?
Yeah, so we have non-disclosure agreements with the companies we've contracted with. So I have to be careful what I say there. But I will say we've contracted with some of the largest nuclear companies globally. We've gotten exceptionally good pricing on those contracts. They are very profitable on an all-in basis. And when I say all-in, I don't mean just to cover the mine side. I mean keeping the lights on in this office, corporate G&A, and on an all-in basis. We are very profitable on those contracts. And those are the kind of contracts that we look to sign up going forward. We believe we're getting a premium above the spot and above the long-term price, because Lost Creek is a very well-known entity. It's a proven producer in a safe jurisdiction here in the U.S. There are no transportation issues like out of Kazakhstan. There are no geopolitical issues like out of Russia. So we believe over time, utilities are going to be looking more and more toward U.S. supply, and they're going to be willing to pay a little bit more for that supply because of its security. So we're very happy with the pricing and would love to sign up additional contracts going forward at that pricing. For this calendar year, 2023, we have 200,000 pounds under contract, has a flex of 10%. But starting next year, 2024, and for about 6 years thereafter, we've got 600,000 pounds under contract, and we're in continual discussions with utilities toward layering in additional sales contracts.
And let's move on now and just touch on the Uranium Reserve Fund. UR Energy did sell into the Uranium Reserve Fund. Maybe you can provide some details on that. How many pounds did you sell and at what price?
Yeah, so for clarity, the 600,000 pounds of contracting that I just talked about does not include the contract that we have with the Department of Energy. So literally just a few weeks ago, we won a contract with the Department of Energy to sell into the Uranium Reserve. We bid 100,000 pounds into that program, and we sold it to DOE at $64.47 a pound. Those pounds have now been delivered to the Department of Energy, and we're expecting the payment on that within a few days now. So we're going to bring in a little over $6.4 million into the coffers from that. The total program that Congress allocated funds for was $75 million. That's a good start, but really there needs to be more done. The Nuclear Fuel Working Group had suggested or recommended to Congress that it'd be $150 million a year for 10 years, each year $150 million for 10 years. So a little over $1 billion. Unfortunately, Congress didn't see fit to approve that. They did a one-time program of $75 million, but there is ongoing discussion within Congress on what can be done to further incentivize the front end of the fuel cycle, mining, conversion, and enrichment. So we'll see where those discussions go. As a company, it's always been our mandate to sell uranium to utilities and be profitable doing that. We have never made it a practice to rely on the federal government for handouts. So really that's not our focus. However, when the US government comes along and wants to sign a contract with us, we'll certainly talk with them, especially if it's a high price contract. But really our mandate is low cost production so that we can sell to US and global utilities at good profit margins. And that's really what we spend our time working on.
And you also are sitting on 224,000 pounds of uranium in inventory. What are your intentions with that?
So when the Department of Energy came out with the RFP, we debated whether or not to sell all of that because it's all US produced, those 224,000 pounds. We produced those, but we didn't go out and buy them. We're a producer. So we thought, should we sell those to DOE or make an attempt to, or do we hold them? We made the decision to hold back on that, not bid it into DOE, so that we would have some feedstock as we ramp up production. If we run into any technical problems, we would have that in our bank account essentially to feed into that contract for this year. So that's our intent, to hold on to it for now. As we get ramped up and the pounds start to flow, we may make a decision to sell that into the spot market, or we may sell it into higher priced contracts. But for now, we're just going to hang on to it, and we'll see where the market goes, and we'll see how production comes along.
John, I want to move the conversation toward valuation now. UR Energy has a lot going for it. It's cashed up. It's sitting on over 200,000 pounds of uranium in inventory. You're ramping up production. You're one of the only producers, if not the only producer of uranium in the US, but yet you're trading at a discount. What are you and your team going to do to close this valuation gap?
No, I appreciate that question. I get asked that a good bit. I guess maybe first of all, a comment on valuations. I think as we look at valuations, it shouldn't be simply dividing pounds into a market cap. That's not the whole story. There's a lot more that needs to be looked at. And I'm not going to name any names, but there are certain companies out there that have assets that are probably require another $5 to $15 a pound in the market before they even reach break even. And so it's not really fair to say divide those pounds into market cap and say that's the valuation, because it's probably years, maybe even decades before those pounds come to market. That's not true for us. At UR Energy, when we've made acquisition, it's only been for pounds that we can produce. So at Lost Creek and at Shirley Basin, those are producible pounds at today's market. And so I think it's fair to divide that into market cap to get a valuation. But investors should be very careful about dividing pounds into market cap. There needs to be a quality factor that's put into that. Our pounds are producible. They've been proven to be economic and profitable in the very recent past. And so that's got to be a part of the discussion. But to more directly answer your question, what are we doing? We're going to do what we said we're going to do. We're going to go into production. We're going to keep our cost very low. We're going to compete with pretty much anybody globally, maybe perhaps Kazakhstan being the exception to that. But we're going to compete with Canada. We're going to compete with Australia. And we're going to be in the lowest quartile on cost production, especially when you look at publicly traded companies. That's where we want to be. We've said we're going to do that. We've done it in the past. We're going to get back to that with meaningful production here in the U.S. We're also going to continue to work on research and development with a goal in mind. Number one, to be sustainable, reduce our footprint. But number two, we're going to drive down our cost through that research and development. And we've got some exciting programs going on there with regard to well casing and well installation methodologies, and also with regard to wastewater treatment. Both of those, if we're successful on those, will drive down our cost in the long term and make us even more competitive on the global scene. But that's our focus. We want to be a low cost producer, and that's how we're trying to add value to the company, a legitimate value story.
That's a great wrap up. But before I let you go, why don't you just tell us what investors can expect in terms of news flow in the coming months from UR Energy?
So ramping up production, we'll keep the public appraised of that as we get flow through the plant at a meaningful rate. And as we fill contracts, we'll keep up the public on that. Also just mentioned research and development. We've had a slight pause in some of that as we are focused on ramp up right now, but within a few weeks, we'll get back to that. And we hope to have a lot more to share on that in the very near future. Beyond that, contracting. We're in continual discussions with utilities on bringing in additional, very good, profitable contracts. And as we're able to sign more of those up, we'll let the public know. And our objective is to ultimately get enough signed up that we can make the go decision on Shirley Basin and get production up to 2.2 million pounds per year. So that's the news flow going forward, and that's our objective.
Well, that was a great overview and a great update on UR Energy. I want to thank you for making time with us today, John, and we look forward to the future updates.
All right, thank you.